Jim, I remember last time you were on, I left after the interview. I felt a little bit better about the prospects for the markets. It has been horrific since your last appearance, but you're doubling down to some extent. You're still feeling okay about things. What are we down? You think we're down 10% since last time? Not quite, but almost in some of the averages. But the same things that made you less worried back then, you still feel that. And what are they? That inflation is already telling us it's peaked, and the Fed's not the only thing that brings down inflation, right?
I think so, Joe. I mean, everybody seems to feel like the only thing standing between them and runaway inflation is the Fed. And I think there's a whole host of contractionary economic policies that have been in the pipeline really since March of 2021. You know, substantial decline in monetary growth, fiscal growth, big rise in the dollar, bond yields started going up in 2020. And that stuff's working through the pipe. And I think that's mainly why inflation's already rolled over and why it's likely to continue to ease over the next year. And I don't even know if the Fed has to do anything more to get that job done. I think the war on inflation has probably been won. We just don't know it yet. Historically, peak inflations have been very good times to buy the stock market. We also have the S&P 500, which is selling at about a 17 times multiple. That's lower than 70% of the time since 1990. We've got really pessimistic sentiment, out there across the investment markets overall. And I think the Fed's tightening campaign, I think it's going to have to change soon. It's just getting too extreme, Joe. Bond yields are heading straight north while commodity prices and ISM price surveys and inflation surprises are all heading south. The mortgage rate's at a 15-year high while the affordability index is at a record low. There's just too much that's out of bounds. The dollar's out of balance, and so something's gonna change. Maybe something breaks. Maybe we get a bad economic report or a really good inflation report. But I think we're getting very close to the end of Fed tightening and a lot of other things that are still pretty good here. And so I think we're going to have a pretty good year in the next year.
If the Fed uses higher rates to slow things down, I mean, certainly orchestrated some higher mortgage rates. So let's check that off. In the past, whenever I've seen violent moves in yields in the bond market, it's always like, well, like back during the 87 crash, the bonds moved like 250 basis points in a day. It was really staggering to watch. And it's like, well, that was because the market was down. Well, it still happened, and the bonds were mispriced when they were at one point. And I'm wondering whether gilts were mispriced. I know that the Bank of England came in and said we're going to do this, but maybe they shouldn't have been as high as they were. And maybe, remember our 10-year? Where was our 10-year before the Bank of England did that? We were well above 4%.
4%, yeah.
Yeah, suddenly we're at 368. Why are we at 368? So maybe you're right, and maybe the Fed's work is largely done, and maybe those are some of the highs that we're going to see in the 10-year. Once again, I'm trying to separate what I want to happen from what is likely to happen, but is that a possibility?
Well, I can't prove this, and I never can prove this, Joe, but, from about June till this month, I think the markets were comfortable, and we're already headed back for a second leg. The 10-year yield had been around the 3.5 area for several months from May through the end of August. Most of the yields have been moving sideways since May or so. I think they had priced in what they thought was appropriate, and they were good.
Until that inflation
and the stock market was taking off, and it was good. And then the Fed decided that it wants to channel its inner Volcker and go rogue. And basically, and say, well, even though the bond market is messaging this, and even though the economy is kind of sluggish, and even though inflation indicators are rolled over, we're going to raise rates, and we're going to raise them like Volcker did, and that's kind of what has really put a curveball into things. So, but let's look at the Volcker moment. The one other time when I think the Fed went rogue was under Paul Volcker in 1980-81. They took the funds rate from 9.5% to 20% in about 6 months. And what that led to was the 81-82 bear market. But the entire bear market went down 27% by August of 1982 after the Volcker moment. We're already down 25% right now. unlike then, the stock market didn't even start falling until Volcker was done tightening. Here, the stock market started falling before the Fed was tightening. So, 25% is discounting a lot. And I think we could have a lot of bad stuff happen that's already in the stock market.